Welcome, everybody. Thanks ever so much for your time and attention. Good afternoon and welcome to the first live event of our free content-led live sessions taking place throughout November and December as part of the Professional Accountancy Online Live, sponsored by Free Agent, with myself, Tony Stevenson, and our expert speakers. So during today's live session, we'll be offering 1 hour of CPD. You will be able to listen to Mike Ulrich present on accounting for COVID-19 support packages, going concern considerations for the accountant. So COVID-19 has given rise to various support packages from central government, devolved governments and the local authorities, and Mike will consider the accounting treatment for these packages. Businesses have also been able to access various loan schemes, and how should these be accounted for under FRS 102, FRS 105. Session will also consider post-period end events and going concern issues. So there will be an opportunity for you to put your questions to the speaker after the presentation. So to the right-hand side, there is a chat function. All the questions are submitted in private, so please ask away. If you're watching a live replay, the live client chat function is disabled, but you may contact Professional Accountancy for further information. So before we kick off, a couple of introductions. So for those of you that don't know me, my name is Tony Stevenson. I'm a practice implementation consultant at Free Agent, where I help accountants to get the most out of Free Agent's award-winning online accountancy software. Spent the first 10 years of my career in practice as a corporation tax consultant before moving into the cloud accounting software industry. Since then, I've been using my experience to support accountants through their transition to cloud accounting software. I'm a fellow of the Institute of Chartered Accountants for England and Wales, believe it or not. So for more information on Free Agent, who is sponsoring today's event, can be found at the online exhibition at www.profaccountancy.com. That's PROF accountancy.com. So without further ado, I introduce today's speaker, Mike Ulrich, ACA. Mike has been involved in presenting courses and seminars to professional accountants for over 20 years. He's a technical consultant on accounting and audit matters to a number of firms, providing answers to real-life issues. He also undertakes compliance reviews, both audit and audit exempt, for a number of firms, and provides advice and guidance as required. Both of these provide him with an insight into those topics, which are of practical interest to practitioners and accountants in commerce. He also has his own practice and is a statutory auditor. With his background, it enables him to see both the theory and practical aspects of the presentations, and the presentations reflect this. So welcome, Mike, and over to you for the next 45 minutes before we move on to the questions from the audience.
Thanks very much indeed, Tony. So hopefully as I would refer to it, the tech continues to work and everybody can get it to work. So if there are any problems, then suggest you possibly use the chat box to try and indicate, particularly if perhaps in the unlikely event that my internet does go down, I'll end up talking to an empty screen with nobody listening. So if somebody lets me know if that happens. Anyway, without further ado then, so let's look at this topic with regard to COVID-19 support packages, etc. and so on. I suppose the first health warning I'd like to give at this particular point in time is, of course, everything is changing. So please bear in mind that within the slideshow and within the notes that have been provided for this session, there is one element which has already effectively disappeared, and that is the one-off bonus that was going to be paid in February, March. So I can't take the slides out at this particular point, but I will just skip over that as and when it arises. So it's important to bear in mind that this isn't the be-all and end-all. The chances are that some of these packages will change again as we move forward into the future. So the first thing that we therefore need to do at this stage is to get the slides to advance. Oh, okay. So accounting for grants, first of all, in this particular aspect. So when we're looking at this from the point of view of applying UK GAAP, I suppose there's one very important question we have to ask right at the very beginning, and that is whatever the income is it a government grant? The reason for that is quite straightforward. If the answer is yes, then we have a specific section in both FRS 102 and FRS 105 dealing with the accounting for government grants. If it's not a grant, then we would just apply the revenue recognition requirements of section 23 of FRS 102 and the equivalent from FRS 105. So if you are on the left-hand side, as far as this slide is concerned, then I suppose one thing to note at this particular point in time is that under FRS 102, you are required to choose a model. I'll look at what those models are and whether they're likely to make any difference or not fairly shortly. So when we're talking about government grants, what do we mean by the term government? Well, as I've highlighted for you on this slide, as far as the standards are concerned, it includes central, devolved and local authorities. So at this point in time, a lot of businesses in particular sectors have received grants from their local authorities. The fact it is from the local authority and not from central or devolved government doesn't make any difference from the point of view of the accounting treatment. So what is a grant? What is the definition? Well, this is the definition from FRS 102. It is assistance by government in the form of a transfer of resources to the entity in return for past or future compliance with specified conditions relating to the operating activities of the entity. Well, let's just highlight three particular aspects at this particular point in time. So the first ones I've highlighted here is transfer of resources. That is generally going to be cash or something else and should be relatively straightforward. The second aspect is for past or future compliance with specified conditions. Now, we need to bear in mind that when FRS 102 and FRS 105 were drafted, COVID-19 did not exist. The support packages that we now have did not exist. So this particular definition was drafted in the way of the grant packages that would have been available at that time, in which case then this aspect of past or future compliance with specified conditions would have been fairly straightforward. So for example, if we had an entity applying for a job creation grant, well, the conditions were quite straightforward. You had to create a certain number of jobs. The same thing applied with regard to investment grants, etc. and so on. Now, the grants that are starting to arise under COVID-19 do not fall into the same category. So, for example, I've already mentioned these local authority grants that have been received by a large number of entities. So what conditions does the entity actually have to satisfy in order to be in receipt of that grant? Well, I suppose the answer would be it has to fall within a particular sector. Secondly, it has to either have been paying business rates of a particular value or have negligible business rates. But these conditions aren't as detailed as they would have been under the original idea of FRS 102. I don't think fundamentally that changes anything. I think whichever way you look at this, most of these support packages are definitely going to be grants. But things like, for example, business rates relief, which is another package that will be available from the government, would not fall within the definition of a grant. Not because there aren't any conditions, because it doesn't satisfy the first aspect of a transfer of resources. I think operating activities is fairly straightforward, and that tries to potentially distinguish, I suppose, between capital and revenue grants. So when we're looking at these packages that are being offered by the government, when should we be recognizing them within the financial statements? Well, that should be on the basis of satisfying the two reasonable assurance tests that are shown for you on this slide. So reasonable assurance that the entity will comply with the conditions and reasonable assurance that the grant will be received. So again, let's look at this historically from the point of view of what might have happened in the past. All the grants received up until COVID-19 would have been received by entities who had to satisfy particular conditions at a particular point in time. And whether you satisfied those conditions or not would probably be approved or would have been looked at or reviewed by another body, and there will be some sort of confirmation process that said, yes, you complied with the conditions. And very often, if that happened, there will be reasonable assurance that the grant was going to be received. With the COVID-19 support packages, the compliance with the conditions is open to, I would say, a certain amount of interpretation in the terms of how is it going to apply. So let's take one of the more popular support packages, the CJRS. So what conditions do you need to comply with? Well, there are conditions laid down, but does anybody review those on an ongoing basis? And the answer would be probably not, because at the end of the day, an employer just needs to submit the claim through HMRC's website. There is a certain amount of checking being done at that particular point in time, but have we got absolute assurance that the conditions have been complied with? Well, I suppose from a particular perspective, from an entity's point of view, the answer to that would be yes. But Is there any chance that at some time in the future, someone's going to turn around and say you didn't satisfy all of the conditions? Well, I suppose that does exist as a possibility. But measuring when there is reasonable assurance is going to be critical at certain points in time. So, for example, as I will highlight fairly shortly, some entities receive grants around about sort of March time in 2020. Some received these grants before March, some received these grants after March. But of course, one of the critical factors here is the most popular year end in the United Kingdom is the 31st of March. So at which point should we have actually recognised that income? You know, if it was received before the 31st of March, should we have deferred it? Or should we have recognised it in that particular period? If it was received afterwards, should we have brought it back into the 31st of March? I'll try and provide a bit of insight with regard to that fairly shortly. So if you're using FRS 102, and please bear in mind that this presentation is primarily FRS 102 and 105. I'm not going to be going into IAS 20 in any shape or form. So if you're applying FRS 102, you need to choose a model. Well, now one of the questions that often arise here from practitioners is, well, if I'm dealing with a small entity and I'm applying Section 1A, do I really need to choose a model because I'm applying Section 1A? Well, we need to bear in mind that Section 1A is only a relaxation from the point of view of disclosure. It doesn't make any difference at all as far as measurement is concerned. So any entity adopting FRS 102 has to choose between two models, performance model and the accruals model. Personally, for most of the scenarios that I've seen in practice, I don't think it's going to make any difference whether you choose one model or the other in terms of the recognition of these COVID support packages. But at the end of the day, the standard says you've got to choose either one model or the other. So the performance model would mean that you would recognize the grant in line with the performance of the grant conditions. If it's the accruals model, you match it against the related costs. So from that, you might assume that in order to use the performance model, there'd have to be some sort of performance related conditions. And with most of the COVID-19 support packages, I don't think there are any performance related conditions that fall within that definition within FRS 102. But it doesn't require there to be any performance related conditions to use the performance model, because the good news is the performance model also has a requirement that if there are no performance related conditions, this is the recognition criteria. And you don't have to use the same model for all grants. So it's not a case of adopting one or the other. You can change as necessary, depending on the nature of the grant. So looking at the performance model, I suppose the clue really is very much, as I've already indicated, at this particular stage. So if we don't have any performance conditions, and with the COVID-19 packages, I don't think that's likely to be the case. When should we recognize it? Well, if there aren't any, we should recognize it on the basis of what I've already indicated. When we've got reasonable assurance that we've met the conditions, and we've got reasonable assurance that the grant itself is going to be receivable. So I don't think that's probably going to create any problems at all. From the accruals model point of view, you're required to match it against the related costs, which should be on a systematic basis over the period. So for example, if I've got a CJRS grant, then logically you match the grant against the payroll costs that it is actually covering. But there are some grants that don't naturally fall within that. And one that I will mention fairly shortly are those local authority grants that were received by many entities earlier this year. And at this particular point in time, I believe there's now going to be a second issuing of grants from local authorities as a result of the recent lockdown for England. And of course, please bear in mind here, I'm not going to cover any of the specific requirements because some of those may differ between England, Wales, Scotland, and Northern Ireland. The important thing to bear in mind here with regard to the accruals model is that if the grant is to provide immediate financial support, then it is recognised when you've satisfied the reasonable assurance tests. Reasonable assurance, you've satisfied the conditions, and reasonable assurance that the grant is going to be received. If you're applying FRS 105, and I fully appreciate as a standard, FRS 105 is what I refer to very much like Marmite. Some accountants love it, Some accountants hate it. It's very unusual to find an accountant who sits anywhere in the middle between those two broad categories. But if you are applying FRS 105, then the good news is you don't have any choices to make at all. You must be applying the accruals model. So I'm then going to pick up on three particular considerations at this particular stage. First of all, CJRS at March 2020. I'm not going to bother about December 2020, because that covered that one-off payment, which has now been cancelled by the Chancellor, but with a caveat, it might come back again at some time in the future. So perhaps we'll need to deal with that as and when. And those grants that I've already mentioned from local authorities. So let's think about this CJRS at around about March time. As I already indicated, 31st of March is the most popular period end in the United Kingdom. And with regard to CJRS at March, it worked as follows. The Chancellor made an announcement that these grants would be available before the 31st of March, but entities couldn't apply for them or receive them until April 2020. So at which point did the entity have a reasonable assurance that it complied with the conditions, and when did it have reasonable assurance that the grant will be received? Well, I think the conditions for the receipt of the grant, in my opinion, and of course this is very much my opinion, were fully highlighted by the Chancellor prior to the 31st of March. And I would think there would therefore be an expectation that if you satisfied those conditions, there'd be reasonable assurance that the grant will be received. So personally, I don't think it makes much difference as to when the grant was received. I think any CJRS being received up until the 31st of March should therefore be recognised on that particular basis. The next one you've got within your handout is December 2020. That's now been cancelled by the Chancellor, so we won't worry about that at all. And now we'll move on to these other grants that were received also around about the 31st of March 2020. But as I've already indicated, as a result of the recent lockdown in England, there'll be more of these grants being recognised. So again, there may be recognition criteria to think about in terms of other period ends. But we're going to cover this particular point in time. It's for 31st of March 2020, but the same basic principles will apply into the future. So these particular grants, these support grants to be paid by local authorities, were announced before the 31st of March 2020. But some entities received it before the 31st of March. Other entities received it after the 31st of March. So if we're looking at the performance model, we have here a grant that has no further conditions, and therefore we should recognize it when we have reasonable assurance we've satisfied whatever conditions there are, and it's going to be received or receivable. And that's fairly straightforward as far as the performance model is concerned. When we look at the accruals model, then we end up with the following aspect. The accruals model says we should match it against the costs. Now, these grants were received before the 31st of March to meet expenditure after the 31st of March. But the principle with regard to the accruals model is you match the grant income against specific expenses. Because remember what I said earlier, there is that caveat that says if the grant is to provide general financial support, it should be recognized when it's received or receivable. Now, because of this, there's been a certain debate as to whether these grants should be recognized before or after the 31st of March. And that debate also triggers around whether we've used the performance model or the accruals model. So what guidance do we have? Well, the ICAW and the ECCA have both issued guidance on these support packages, not just on these grants, but on all the other items that I'm covering as part of this presentation. So the ICAW guidance was issued in May 2020, the ACCA in October 2020, and they conclude that it doesn't make any difference which model you apply. Effectively, you should be applying basically the same criteria. So there should be no aspect here that if you're applying the accruals model, you should defer that into the following period because it's to meet expenditure, because it's not specific expenditure. You can't say that the grant is being received to meet a particular cost. It's for general costs. and therefore you could also have a debate as just to how far into the future this grant is being paid in respect of. So when might we have had entitlement to this particular grant? Well, guidance from the government said that entitlement was the date on which the grant was paid by the local authority, or the 1st of April 2020, the earlier of those dates. But the eligibility date within the government's guidance to local authorities was the 11th of March. Therefore, I'm going to make a suggestion that in many instances, these grants should be recognised before the 31st of March. So the conclusions here would be with regard to the performance model, there are no future performance conditions. So we recognise on the basis of when the grant's received or receivable. So if you've got certainty the grant was going to be received before the period end, then you just accrue it in the normal way. With regard to the accruals model, then obviously the expenses or losses are to be, it is in respect of immediate financial support. So it should be when it's received or receivable. So fundamentally, at the end of the day, it doesn't make any difference one way or the other. Now, one area which I think is going to prove to be an issue in respect to these COVID support packages is disclosures within the financial statements. Now, as Tony mentioned within the introduction, one of the things I do for some firms is I carry out reviews. And the one thing I've always noted over the years is that one area of the financial statements that often raises quite a few questions is everything to do with accounting policies. I might be being slightly cynical here at this particular point in time, but I rather get the impression that sometimes the accounting policies included in the financial statements of small and medium-sized owner-managed businesses have more to do with a software package that the accountant is using rather than anything else. Now, the reason I come to that conclusion is that very often accounting policies seem to have been selected on the basis of perhaps some sort of pre-read list or some pre-populated list that's available from the software package, or it's just repeated from the previous year. And of course, if it is repeated from the previous year, then the chances are if an error was made in the previous year, it just gets carried forward into future years. But what about these ones with regard to accounting policies? The one thing I've also noticed with regard to this is that very often you get accounting policies which are completely irrelevant as far as the entity is concerned. So, for example, I often see accounting policies for the revaluation of certain fixed assets when, in actual fact, the entity has never carried out a revaluation. I've even seen that accounting policy for an entity that doesn't actually have any fixed assets. So I think one of the things we need to bear in mind as far as this is concerned, and this will apply even if you're applying Section 1A, is you're going to need to disclose an accounting policy for government grants. And of course, added to that is the following. Many entities receiving COVID-19 support grants would never have received any grants at any time in the past. So this will be what's referred to as a first time. So therefore, the chances are, if you follow what I've already said, if it wasn't there last year, it may not be there this year. And of course, if it's FRS 102, naturally you would have to mention whether you've applied the performance or the accruals model. If you're applying Section 24, then yes, you'll need an accounting policy together with a few other disclosures as well, which are covered for you on this slide and within your handout, which I suppose then raises the following question. What would you be disclosing under FRS 105? And the answer is nothing. Because FRS 105 micro entity accounts are deemed by legislation to show a true and fair view. And therefore, because they're deemed to show a true and fair view, if you satisfy the statutory disclosure requirements, then that basically is all that is necessary. So FRS 105 accounts do not require any further input whatsoever. So from a practical point of view, might I just stress the point, for many entities, this will be the first time they've ever received any government grants. So the disclosure will need to be looked at very carefully indeed. Now, there are potentially a couple of complications here, which I will bear in mind a little bit later on. But things like, for example, if you've got any employees on 0-hour contracts, and if you've got any employees from a public sector point of view who are what's referred to as off payroll and therefore taxed with PAYE, etc. and so on, I stress it is public sector, not private sector. then please remember that the announcement of extending the CJRS to them was actually made in April. It wasn't available at the 31st of March, and that may be an issue for reasons which I will cover fairly shortly. So now just picking up on a couple of elements with regard to these packages on an individual basis. So the small business grant, I suppose I covered the basic element at this particular point in time, and I suspect that only therefore leaves one question unanswered at this stage, which is how are we actually going to present it? Well, if you're applying FRS 105, I'd make the suggestion, include it as other income, and you don't have any obligations to disclose anything further for reasons that I've just mentioned. Remember, those accounts are deemed to show a true and fair view. If you're applying FRS 102, then you could refer to it specifically, or you could include it as part of other operating income. Now, there'd be no statutory obligation to disclose any further information, but please remember here, there's a difference between 105 and 102. Under FRS 102, the disclosures within Section 1A are the statutory minimum. They're not the maximum. They are the statutory minimum. Because under FRS 102, there is always a need for the financial statements to show a true and fair view. And therefore, if it is felt necessary to show a true and fair view, then further information would have to be given with regard to the grants. And that's a judgmental, that's a professional judgment at the end of the day. With regard to CJRS, it is a government grant. When should you recognise it? When you satisfy the reasonable assurance they've already covered at this particular point in time. If you're dealing with the 31st of March 2020 period end and you have got 0-hour employees, then I'm going to make a suggestion. The announcement of extending the scheme to them was made after the 31st of March. And when we prepare financial statements, they recognise the conditions which existed at the period end, not that arose afterwards. So my suggestion would be, in those circumstances, at the period end, there was no information to indicate that that scheme will be extended to 0-hour employees. Account increment is exactly along the lines that I've already indicated at this particular stage. I don't think it makes any difference here whether you apply the performance or the accruals model. I think the recognition will be exactly the same. So the same principles would therefore apply. In the terms of presentation, there is a danger area here that accountants need to bear in mind. For many employers, they can see there is a direct relationship, well, because there is a direct relationship between the CJRS grant and the employee costs. And there may be an inclination to offset one against the other. So what you end up with in the financial statements is effectively the net figure from the point of view of the expenditure. You cannot net off the grant against the expense. If you look at FRS 1 and FRS 102 and 105, then it's not mentioned at all. And the reason why you can't net one against the other is down to the regulations, which do not permit income expenses to be offset. Interestingly, and this is only for interesting purposes, if you're applying IAS 20, you could net because the regulations don't apply to accounts prepared under IFRS. So the Corona Business Interruption Loan Scheme in its various guises, etc., what are the specific aspects we need to bear in mind with regard to that? Well, there's been a bit of a debate going on with regard to these grants, which does have an impact under FRS 102, but not really under FRS 105. And the question here is, as a result of the government support for these loans, does it mean that the entity ended up with a interest rate which is below a market rate of interest? Why does that become important under FRS 102? Because 102 requires in those circumstances that the loan should be shown at its present value, not at the transaction price. Now, I'm going to suggest at this point in time the following. One, the fact the government offered the support, the fact the government offered the support does not necessarily mean for everybody that the loans are at a rate of interest which is below the market rate. This issue is identified by the ICAW in their documentation, but is not indicated as an issue as far as the ACCA is concerned in their documentation. So I'm not saying that what I'm about to cover from that particular perspective is either the right or the wrong answer. It's going to be a matter of judgment as far as that is concerned. And the best way of showing the accounting for these loan schemes is to use an example, which you have got forward within your handout. And I'm going to go through fairly quickly as part of the presentation. So an entity is borrowing £100,000 over 5 years, interest rate at 5%, no upfront fees, and loan interest is paid in equal installments at the end of each period. Now, I fully appreciate that it's completely and utterly unrealistic from the point of view of what actually happens in practice. But we need to just basically look at the fundamentals here, and then that puts us in a position to be able to apply those to live situations. Now, if that loan had not involved anything to do with the interruption loan scheme or not, and we're applying amortized cost, this would be the profile of the payments. Remember, under amortized cost, we're supposed to end up with a constant rate of interest on the amount outstanding. So we'd end up with interest of 5,000 in the first year, etc., and so on. Yeah, I know this slide is possibly slightly at fault because the figure in the bottom right-hand corner shouldn't be 3, it should be nil, but you'd lose the £3 somewhere over the period. Now, if we're therefore going to apply the loan scheme, one way of looking at this, which is not applying the ICAW, that this is a financing transaction, would be as follows. We don't pay any interest in year 1, so let's make an assumption, therefore, that the payment made by the entity is reduced by the amount of interest that's going to be paid for by the government. So therefore, when we apply the model, we end up with the following figures. And you'll notice here that at the end of the day, the only difference between this, which is without the loan scheme, and this, which is with the loan scheme, is we've got no interest in the first year. And the good news is by double entry, we could include that. We could debit interest 5,000 and we could credit the government grant with 5,000. So we'd end up with exactly the same process, end up with exactly the same figures, but of course we've got the government grant there as well. And please remember what I said earlier, no thoughts of offsetting here. You couldn't offset one against the other to end up with what is called a zero result. Now, if you follow the ICAW, Technical Advisory Service, they suggest that because of the government guarantee, effectively you end up with a financing transaction, so you need to show it at its present value. And for exactly the same loan, you would end up with this particular profile in order to show that. So effectively at the initial transaction point, you'd end up with debiting cash, 100,000, crediting the loan with 95,238, crediting profit and loss with 4,762. How do we arrive at the 4,762? Well, that is the present value of £5,000 discounted at 5% for 1 year. At the end of the first year, you then debit interest, 4,762, credit the loan with the 4,762. So effectively, you end up effectively back to exactly where you were when you started. So in the first year, as far as the P&L is concerned, there'd actually be no cost whatsoever in net terms. Now, of course, the problem with that example is it's just not realistic. So, for example, it is possible that the loan will not be repaid in equal installments. It's unlikely that the interest rate is going to be fixed. It could be effectively the interest is charged by the bank on the basis of monthly repayments, which ultimately would end up with amortized cost. So you don't have to go through the entire process. And if we are going to be thinking about making a disclosure with regard to interest, etc., and fees, do we know what those are going to be in the first place? Because that's an arrangement between the financial institution and the government. Now, the business-backed loan scheme is also one which I understand has become incredibly popular. As one of my clients explained, it was probably the cheapest money available on the market at that particular point in time. And I have a suspicion there may be other businesses that went down exactly the same route. Now, with regard to the business-backed bounce-back loan scheme, it's pretty similar to the interruption loan scheme. The accounting requirements are broadly the same. I suppose the real difference is that there's no interest in year 1 because the government will pay it. But importantly, there are no repayments in year 1. Also, which is something slightly different, the interest rate is fixed at 2.5%. Now, within your handout, I've gone through exactly the same process of looking at the accounting for this if it wasn't under this particular loan scheme. And I've also looked at it from the point of view of it being under the particular loan scheme. Now, the only real difference here is that in year one, we've got no interest and we've got no payments, and therefore the amount to be paid, etc., would be adjusted accordingly. I think it's exactly the same considerations, and of course, subject to a judgment call, you could also think about this as potentially being a financing transaction in line with the ICAW observations as well. Now, together with this whole COVID-19 and the accounting issues that are likely to arise, we've also got this aspect with regard to rent holidays as well. A lot of businesses, as tenants, have had either reduced or nil rental payments over a period of time. So how should we account for those? Well, broadly, there are two views as far as this is concerned. The first is the charge to profit and loss will be exactly as incurred. So if we end up with 3 months with no rent being paid to the landlord, we effectively just take the 3 months with no rent. The alternative view is you work out what the reduction is going to be in total and then spread that over the period to the end of the lease in a bit along the same way as you would do with a lease incentive. Well, let's make something quite clear at this particular stage. This is not a lease incentive. So there'll be no requirement to spread. Lease incentives only arise at the commencement of a lease, not part the way through. And please also bear in mind, there is guidance available from the FRC at the moment, as far as I'm aware. It is only as Fred 76, and it proposes the top route, not the bottom route on this slide. So it suggests if you satisfy the conditions with this amendment that's going to be made to FRS 102, then you should effectively take the reduction in the periods which are actually affected by it. So the next topic to be looked at, as far as this is concerned, is the whole aspect of COVID-19 and going concern. This is going to be potentially a fairly tricky issue. So let's just remind ourselves of what the requirements are under both FRS 102 and FRS 105. There is a requirement to consider whether there are any material uncertainties which cast a significant doubt over the ability of the entity to continue as a going concern. And that has to be up to the date of authorization for issue and for at least 12 months beyond that date. So that is a requirement within FRS 102. And if there is a material uncertainty casting significant doubt, then that is required to be disclosed. Now, as I will point out to you fairly shortly, ultimately that's going to give rise to broadly 3 possibilities. But let's just clarify one element here at this particular point in time. FRS 105 also makes assumptions with regard to going concern, but there is a big difference between 102 and 105 in this area, and that is in respect of disclosure. As I've already mentioned this particular point in time, FRS 105 financial statements are deemed to show a true and fair view, provided the statutory disclosures have been met. And if you've ever seen a set of FRS 105 accounts, then let's be quite honest, satisfying the statutory disclosure requirements is never going to be a challenge. After all, in many instances, you can get the financial statements onto basically 2 pages of A4 paper. Now, going concern is not one of the statutory disclosures. And because whatever you do is deemed to show a true and fair view, you can't use the argument of a true and fair view to require any further disclosures. So an entity applying FRS 105, for example, that does have a material uncertainty casting a significant doubt, has no disclosure requirement at all. And it cannot be suggested that it should be there on the basis of showing a true and fair view. So this is the period over which we're required to give this consideration. So to a certain extent, it's up to a particular point in time in respect of known information and looking at for a projection for at least 12 months into the future. So how does this sit from the point of view of the accountant? I'm not going to discuss this from the point of view of an audit, because at the end of the day, the auditor's responsibilities in this area are going to be slightly different to that of the accountant. So what we might be doing in looking at this particular slide is saying to ourselves, if we're involved with an entity, what are we expecting in the terms of the director's view in respect of going concern? Are we going to be looking for cash flow projections? Are we looking for reverse stress testing, etc., and so on? What should be there if we're an accountant to indicate whether there are any material uncertainties casting significant doubt? Well, if there's no audit process taking place, then there is no requirement for the accountant to test any of the assertions, to gain any evidence. All they've effectively got is their professional responsibilities at the end of the day. And those professional responsibilities are summarized by the ICAEW and similarly by the ACCA in their guidance as follows. Financial statements that a professional accountant is involved with should not contain materially false or misleading statements. They should not contain information or statements which are furnished recklessly, and they should not obscure or omit information. So basically, they should show a true and fair view. So where does that leave us? Well, these are the three possibilities. How you get to whichever one is going to be a matter of professional judgment. But just to draw attention to the fact, if the entity is not a going concern, that is, the directors have already made the decision, it's not going to be continuing, or they've got no option but effectively to reduce the scale of the operations, then you should not be using the going concern basis. You should be using another basis, which means that assets and liabilities will be shown at their at their realizable values. If there are material uncertainties, then there should be adequate disclosure. And it doesn't necessarily mean as a result of COVID-19 that all businesses will have a material uncertainty creating a significant doubt, because there's absolutely no doubt that some businesses have done remarkably well out of the COVID-19 situation. In other words, their trading has not been adversely affected. And I suppose the last item to cover at this particular point in time is always remember, as I indicated earlier, that the financial statements represent the conditions which existed at the period end. And that's why we've always had adjusting and non-adjusting events. And it doesn't matter here whether this is FRS 102 or FRS 105. So an adjusting event will be one where it provides further evidence of the conditions which existed at the period end. If whatever it is arose after the period end, then it's non-adjusting, which means fundamentally you cannot adjust the financial statements for whatever it is. So how does that sit with COVID-19? Well, here's a few period ends for you. And I am fully aware that some people listening to this webinar are probably still dealing with 31st December 2019 period ends, because please remember, there was an automatic extension applied by Companies House to filing deadlines. So let's just clarify this for you from the point of view of these period ends. It is generally accepted that for 31st December 2019, COVID-19 is a non-adjusting event. That means you can't adjust values for debtors, inventory, investments, etc., and so on. If whatever has happened here is a direct result of COVID-19, you cannot provide for the impairment of either debtors or inventory. If the period ends as the 31st of March and onwards, then COVID-19 is definitely an adjusting event, is a known event. So as I term it, if your period end is January or February, I wish you all the very best of luck. I've given you the two ends. What you decide in the middle, therefore, as adjusting and non-adjusting is going to be a matter of professional judgment. So at the end of the day, please remember, we need to reflect the condition which existed at the period end. If it arose afterwards, it's called non-adjusting. So the next slide, if we're lucky, should be this one, which means we've now reached the end of the presentation. We're now down to questions. So I'm going to pass back to Tony now to deal with any questions. Thank you.
Thank you very much, Mike. Hopefully you can hear me. I'm back off mute again. Cracking session, much appreciated. So we have got a question from the floor, which we've got some time for. So the question is, Mike, are there ever any deferred tax implications on the different ways of accounting for government grants?
Good question. Well, a deferred tax situation is going to arise when you've got a timing difference. So you'd have to have a situation where something was accounted for differently for tax purposes rather than for accounting purposes. Now, the only one that I can think of here that may create an issue, and I'll have to put a caveat in here, as what may be referred to as a technical consultant, I do accounting, I do audit, I do company law, I don't do tax. So I'm at a slight disadvantage here from the point of view of this, but I know there have been some scenarios raised where, for example, particularly with 31st of March period ends, where we've had these local authority grants being paid. Now, some people have interpreted that they will end up for tax purposes as falling within year end 31st of March 2020. But some businesses are then going to defer that for accounting purposes into the following period. If you did that, then you would have a timing difference because that grant has been dealt with differently for tax purposes and for accounting purposes. Now, if you listen very carefully to what I said and you follow the ICAW and the ACCA guidance, their suggestion is this should not arise. And I think the real issue here is probably more tax related, because what it means is that income is falling into the 31st of March 2020 period end, when the business then has to potentially fund the tax on that grant, but it's to meet the expenditure which they think is going to rise in the future period. So it's a bit like sort of a mismatch from that particular perspective. But I see it more like I see it definitely for what I refer to as more of a tax aspect rather than anything else. Apart from that, I can't think of any other situations where it's going to arise, but please bear in mind what I said earlier. I am not a tax person. I'm not into loan relationships, etc., and so on. I can deal with the accounting, but even for the tax, I don't even do the tax for any of my own clients. So that's all. That's about the best I can offer at this stage, Tony.
Excellent. No trouble, Mike. No trouble. Thanks for that. So the next question may possibly be our last. We might have a minute or two more. So is there likely to be any difference in the recognition of COVID-19 grants under the performance or accruals model, and do you have to apply the same model to all grants?
Well, the answer is I don't think there will be. That's a personal view. At the end of the day, because it's based on a reasonable assurance you've satisfied the conditions, and reasonable assurance that the grant is going to be received, there is always going to be an element of professional judgment. Like many things in accounting, they are very rarely what I refer to as black and white. They're normally what I refer to as various shades of grey. Some get what I refer to as very deep grey towards black, others get towards light grey, which I refer to as being white. So it's not possible to say a definite either yes or no, because it's subject to reasonable assurance, which in its own right is not a defined term. So personally, I don't think it will make any difference, but that is a personal view. And certainly that is supported by both the ACCA and the ICAW in their guidance. They don't think it's going to make any difference either. In terms of do you need to apply the same one to each, the answer is no, you don't. You know, you can apply either the performance or accruals. The only thing I would say is if you apply a model to a particular grant stream, so for example, CJRS, you've got to apply the same model to that particular grant stream, but you could apply a different one, for example, to the small business grant. Frankly speaking, is it going to make any difference? Probably only in the wording of an accounting policy under FRS 102. I don't think it will make any difference to the numbers that go into the financial statements.
So it's mere semantics.
Correct.
And the final question, Mike. So why is there no requirement to disclose going concern issues in FRS 105 financial statements?
The reason for that is that, for reasons I mentioned earlier, it's the way that the law is phrased with regard to FRS 105 financial statements. Because it includes this aspect of a deemed true and fair view, which we've never had in the past. FRS 105 accounts are the only set we've ever had historically. And I'm going back to when I started in accountancy, which was, of course, only a few years ago. You can tell by the colour of the hair, it wasn't that long ago. We've never had a situation where a set of accounts have been deemed to show a true and fair view. So the important aspect there is you have set out a set of disclosure requirements, which are fundamentally a profit and loss account and a balance sheet, together with a few supporting notes, which of course doesn't include such things as accounting policies, etc., and so on. It just includes certain aspects with regard to commitments, loans to directors, etc., and so on. So it's not very long indeed. Now, because going concern is not within that list, there's no statutory obligation to disclose. And because the accounts are deemed to show a true and fair view, I couldn't, as a professional accountant, suggest to a client who's preparing FRS 105 accounts that I think you should put this disclosure in order to show a true and fair view. Because by definition, by statute, they are deemed to show a true and fair view even without it. So you can't even use what I refer to as the true and fair magic wand to suddenly suggest that this should be included. The same does not apply to FRS 102, because I'd also refer to the fact that there is no statutory obligation to disclose anything with regard to going concern under FRS 102. But if there were material uncertainties creating a significant doubt, though the directors or perhaps the accountant feel that these disclosures should be made in order to show a true and fair view. It's a different situation, completely different situation. At the end of the day, with regard to FRS 105 accounts, I normally describe these as being absolutely useless to everybody. I don't mean useless to third parties. I mean useless to everybody. You know, even management don't get much information out of it. That's why it perhaps comes down to what's called the Marmite effect. You either love them or you hate them.
Depends whether you're the one that's got to file them or not, I guess, doesn't it? You probably love them if they're the ones you've got to file.
Personally, I love them.
Cracking. So that's all the questions that we've got time for. Just before we move on to the closing remarks. There's been quite a number of people who've messaged me privately to say how useful the content was and how helpful they found it. So thanks ever so much, Mike. Feedback's been really good. There's also been a number of people who've asked, is the recording going to be available? Are the slides going to be available? Are the notes going to be available? Yes to all of those. They will all be made available to you afterwards, so don't worry. We'll get those over to you, as we've made them available. So final comments. So unfortunately, that's all we have time for today. Thank you for attending Professional Accountancy Online Live, sponsored by Free Agent. Thanks to our expert speaker, Mike Ulrich. Thank you for all of your questions. Please don't worry if your question wasn't covered today, as we'll be collating all of them as we go through the various webinars as we move through the next 2 weeks of sessions before our sort of final Q&A session. And we'll be addressing all of them in the session on the 16th of December. In the meantime, if you do think of any questions that you'd like us to raise at that particular event, then please don't hesitate to get in touch to submit these via Webinar Jam, either before or during the next live event. Don't forget there are further live sessions taking place every Wednesday for the next 3 weeks at the same time as today, details of which can be found to the right-hand side and also on profaccountancy.com. That's www.profaccountancy.com. Next week's session will be presented by myself and Val Stewart, covering the most topical areas for small company accounting. Don't forget to join Professional Accountancy's online community on LinkedIn to continue the debate after the live session and to be included in exclusive offers for next time. Recording of today's Q&A session will be sent out via email within the next few days. Feedback forms for them will also be sent out when the event closes. By completing this, you'll receive your CPD certificate. Please don't forget to visit the online exhibition at www.profaccountancy.com. By visiting the exhibition, you can access a free 1-hour CPD webinar from the 2020 Distance Learning Catalogue. You can also visit our exhibitor profile for more information on Free Agent. Thank you again for your time and attention, and a big thanks to Mike. A really informative session that it seems like everyone got an awful lot out of. So thanks ever so much, folks, and have a great day. Thank you very much. Cheers.